U.S. May non-farm payrolls added 172,000 jobs, far exceeding market expectations, directly crushing Wall Street's hopes for a rate cut this year. The Nasdaq index plunged 4.2%. This means high interest rates will persist longer, putting prolonged valuation pressure on your tech stock holdings and all risk assets. This is geopolitics and economy. This video represents only personal views and does not constitute any investment advice. Markets carry risks. Invest with caution. Key topic 1. Global liquidity is drying up. The strong U.S. jobs data extends the high risk-free rate plateau. Wall Street funds are shifting from overvalued AI stocks to traditional defensive and energy sectors. More notably, rumors suggest SpaceX is preparing a massive IPO, potentially valued at $1.75 trillion, raising up to $75 billion. Such huge capital demand, combined with surging treasury yields, is mercilessly draining Wall Street's liquidity pool. In fact, the crypto market already experienced a dark washout, with total market cap evaporating nearly $390 billion. The core of this crash, macro-wise, high rates reduce appeal for non-yielding digital assets. Micro-wise, the SpaceX IPO and AI tech stock suction are starving incremental capital. The current short-term bounce is merely a technical repair after billions in leveraged long positions were liquidated, lacking continuous spot buying support. In other words, dollar liquidity is forming a black hole, sucking away global risk capital. This may signal a brewing U.S.-led global liquidity drought, with emerging markets and volatile assets facing more frequent flash crashes. Key topic 2. Geopolitical risk premiums are soaring. Escalation of the Israel-Lebanon conflict has triggered temporary airspace closures across multiple Middle Eastern countries, reigniting geopolitical risk premiums. Syria's Civil Aviation Authority suspended operations at Damascus International Airport. Syria and Iraq both urgently closed their airspace. Iran resumed missile strikes on Israel after weeks of truce. The spiral of conflict directly threatens the global oil supply lifeline. In my view, this geopolitical risk premium rise is expected to last at least into the third quarter. Brent crude could find strong support above $90 a barrel. Meanwhile, the stagflation nature of global energy is intensifying. Though earlier rumors of a 2.6 million barrel per day oil gap need verification, the vulnerability of Middle Eastern air defense means traditional routes from producers to Asia are extremely risky. Global supertankers, or VLCCs, are being forced to reroute via the Cape of Good Hope or seek safe corridors, rigidly locking in ton-mile demand long-term. In short, oil shipping firms are transforming from cyclical stocks into quasi-monopoly rent-collecting assets with strong defensive traits. Companies like COSCO Shipping Energy may benefit. Meanwhile, Europe and Germany are pushing to de-escalate the Eastern European conflict to stabilize gas and commodity expectations, facing high industrial energy costs. Key topic 3. Global-based materials trade barriers are accelerating an iron curtain. The European Commission has officially introduced extremely stringent steel safeguard measure amendments. From July 1st, duty-free import quotas will be strictly capped at 18.3 million tons annually, a 47% plunge from 2024 levels. More critically, out-of-quota punitive tariffs have doubled from 25% to 50%. The EU also introduced melting and pouring origin traceability requirements, aiming to completely block China and other Asian nations from circumventing tariffs by third countries. The UK is also preparing a fierce counterattack against the EU, in retaliation for the EU unilaterally slashing duty-free import quotas. The UK government plans to cut its own duty-free steel import quotas by 60% from July 1st, imposing retaliatory tariffs of up to 50% on excess volumes. This marks the US-Europe crackdown on Chinese manufacturing going global, moving from electric vehicles to basic raw materials. In other words, the US, UK, and EU have formed a tacit alliance, rapidly descending from semiconductor decoupling to strangling high-energy basic materials like crude steel and primary aluminum, with strict quotas and high punitive tariffs. The era of unrestricted Chinese heavy chemical capacity going overseas is over. Companies like Baoshan Iron and Steel will see their high-margin premium product export channels directly cut off. Key Topic 4. China reshapes overseas asset security review boundaries. China's National Development and Reform Commission unprecedentedly delayed approval of Zijin Mining's $4 billion acquisition of Allied Gold. The core review focuses on extreme security and coup risks in target asset country Mali. This signals that the Chinese government is slamming the brakes on the reckless expansion cycle of resource SOEs and giants that buy mines at any cost. Going forward, Chinese miners' external M&A must yield to national strategic asset security reviews. Mining and infrastructure development in high geopolitical risk regions will face extremely stringent state capital safety assessments. Consequently, companies like Zijin Mining face a Davis double-kill valuation collapse. The market's illusion of unlimited cross-border expansion and exclusive resource cycle premiums has been shattered. In fact, this reflects a top-level shift in China's industrial chain overseas strategy, from scale at all costs to bottom-line risk control first. This isn't just about curbing corporate M&A. It's a strategic adjustment of China's overseas asset portfolio to cope with an increasingly complex and uncertain global geopolitical environment. Key Topic 5. Deep backlash of Russia's wartime economy. The Russian central bank was forced to postpone the full launch of the digital ruble for some systemically important banks to the end of 2026. This exposes the weakness of Russia's financial infrastructure upgrade under sanctions and isolation. Freshly leaked finance ministry letters and industrial data reveal deep economic distortion. In the first 4 months, industrial output rose a meager 0.7%, entirely driven by a 57% surge in heavily state-subsidized military-industrial complex output, such as shipbuilding and aviation equipment. Excluding defense orders, Russia's civilian economy is rapidly hollowing out due to labor shortages, high borrowing costs, and capital scarcity. The wartime dual-track system is eroding Russia's long-term competitiveness. Interestingly, Russia's record wheat harvest pushed domestic prices down about 22% year-on-year. Russia is using its grain pricing power to offset energy sanction losses and suppress global core inflation. In other words, Russia's economy shows dual polarization. On one hand, the agricultural sector has anti-inflation properties, offering global central banks breathing room to cut core inflation through cheap wheat dumping. On the other hand, the energy scorched earth policy and bloated military-industrial complex mask civilian IT infrastructure weakness and brain drain, slowing the financial decoupling process. Key Topic 6. Thaw and restructuring of East Asian regional supply chains. China and South Korea's transport ministries reached a historic agreement on major flight rights expansion after 7 years, increasing weekly passenger flights by 70 to 664. This signals a substantive policy thaw in long-frozen bilateral commercial, trade, and tourism links since the THAAD incident. The micro-repair of East Asian supply chains will first ignite a recovery in cross-border duty-free, business travel, and premium aviation demand. Companies like Air China will see short-term event-driven gains. However, South Korean stocks were battered on Friday, with the benchmark Kospi index plunging 5.5%. Chip Gayant SK Hynix stumbla 9,9%. Samsung Electronics slumpet 6,4%. This came after US AI chip giant Broadcom's guidance fell short, triggering a bloodbath in AI chip stocks. Foreign capital, panicked about peaking tech cycles, is indiscriminately dumping East Asian semiconductor core assets. In short, while China-South Korea relations warm, East Asia's tech sector remains highly dependent on U.S. macro policy and tech cycles. High interest rate stickiness and micro-level earnings peaks form a double kill. Capital is fleeing high-valuation tech and East Asian semiconductor stocks, adding structural uncertainty to the regional economic thaw.